Welcome everyone to August 21st. Looking forward to giving you an update today on the first half of 2023, as well as an update on our firm. Marshall, nice to see you over the camera here. Why don't you get us started by giving folks an update on how things have been for 2023 for ourselves and for North Road? Where would you like to start?
Thanks, Cary. Wow, it's been an incredible journey for us here at North Road Investment Counsel. A year that we're not going to forget.
That's for sure.
It's been an extremely busy year. A lot of changes have been going on in our lives, and there's been a lot of weekends working in the office, and definitely lots of evenings going on. So maybe I'll just give a little bit of an update on terms of like where we are, kind of why we made the changes that we did, and Cary, chime in on your experiences as well as we're going. So, in the back end of 2022, we became informed of a change that Mercer was going to be making, and that didn't quite fit into what my particular career goals were at the time. So, I needed to make a decision around starting an investment counsel firm in Edmonton or making a change to another firm. And I thought the best course of action for myself and the team here was for us to start a new firm. So in order to do that, we actually have to go to the government and ask for permission to do the work that we were doing as an investment counselor. So we started the application process with the Alberta Securities Commission, I guess late in 2022. And thankfully, in February of 2023, we were officially given the permission to act for North Road Investment Counsel. And Cary, you were right in that journey with me, and there was no shortage of reports and applications that we were making, right?
That was a big day. I remember a lot of screaming when we got the note from the Securities Commissions. We're pretty, I think, calm and collected and professional, but that was a day when there was a lot of jumping for joy for sure, because a bit of the path forward was a little more clear.
Yeah, we were certain it was going to happen, but it was just nice to know officially that the firm is registered. Like we can be a corporation, we can set up all the financials, but until the government gives you the authorization, then you can't do the work. So and then transitioning the practice from that of Mercer to that of North Road, you actually have to you can't be registered with two firms. So I was the individual that left first and became, an employee of North Road and registered myself as a portfolio manager with the ASC and other provinces as well. And then Cary, you stayed behind and kind of worked on the transition, and that was an interesting period in our professional lives as well, right?
For sure. I don't know if I ever told you this, Marshall, but at one point, probably in June after we'd made the full transition, I remember walking down the street and looking around at all the people around me and wondering if I was safe. And my life is very safe, but the stress of those few months had definitely gotten into my brain and made me feel like I needed to be on heightened alert at all times. And I was not leaving work at work very often. Yeah. So it was a lot of work. It was stressful, but I'm pretty happy now that we're on the other side.
Yeah, that's for sure. So we made an important change in our business to work with a new custodian. And this decision was not made lightly, but we thought, given that we were going to have to repaper the kind of the administrative relationship information that we have with all of our clients, that this was probably the right time to do that. It definitely made the work more significant while we were transitioning, but it has made our lives significantly better. And I thought we should just spend just a minute talking about the transition to Credential. So Credential Securities is the business that our clients' assets are custodied at, and Credential Securities is owned by a Viso, which is a combination ownership of the central credit unions here out west as well as Desjardins. we were pretty impressed with the technology, the service, and some of the business processes that Aviso has. And now that we are fully transitioned onto that platform, we're kind of reaping some of the benefits of making that change. We are getting a few questions from clients like, who is Aviso? Who is Credential Securities? And I thought it'd be important just to mention that Aviso and Credential, they are the same firm. We are being told that the brand Credential Securities is going to be retired later this year, and our clients will only see the brand Aviso. So it's something to keep in mind.
Marshall,
Anything
maybe
to add?
Yeah, let me hop in with an anecdote here. I am frequently find myself smiling when I hear Rhonda from the front room sort of whoop with joy at how quickly service is being done at Credential Aviso. That was not the case with our previous custodian. There were many days of us having meetings, kind of pulling our hair out, for some service concerns. So it feels great to see everyone on the team reaping the benefits of what was at the time a pretty challenging conversation for us to make that decision.
Yeah, absolutely. The other thing to note is the Mercer has delivered final statements, and our clients should have all received the statement by mail. We've been going through these statements and confirming the details that we're seeing to reconcile the transfers. The other thing that we've been working on is transitioning our phone system from Mercer over to a system that we're going to own independently, and that process is almost complete. That has taken a lot longer than we thought it was going to take. There were some technical challenges in that transition, and we've been having to use cell phone lines for communication, but our phone numbers are active. They are working. They are the same phone numbers that we've had for at least for myself, for close to 15 years. So that's good to get that back and working.
Absolutely. And Marshall, just to be explicit, I think everyone knows, but we are in the same office. I've had that question a couple times as I've seen folks over the last few months, whether clients or otherwise, who've asked about the transition and where we moved to. So we're in the same office. We have the same phone numbers. We're getting back to operating under the new normal. It's new, but at least normal at the very least.
Yeah, absolutely. We've launched a new a mobile app for viewing portfolios. So we've made an investment in a investment management system and a kind of client information system that's unique to us here in North Road Investment Counsel, and we are wanting and encouraging all clients to make sure they activate their access to the portal. And this is going to be the primary way that we're going to be delivering the quarterly statements to our clients. So it's really, really important that activation happens. And we will be reminding you to activate it if you don't do it on your own. But this is hopefully a good reminder.
Agreed. The other area, Marshall, I don't know if you want to mention more about the app or about statements, but I think we should also touch on the fact that we've been spending a lot of time building out systems internally around the investment side. So should we move on to that, or was there something else you wanted to mention on statements?
Timing of statements, Cary, the Q2 statements are going to be delivered very quickly. Our hope is to have them out within the week or even next week. So hopefully in August, we're going to be able to deliver that statement. There will be potentially some questions that clients are going to have on the statements. We're ready to answer them. It's going to take us a little bit more time than normal just because there's a few more statements that we need to verify. But the information that we're seeing now is correct, and we should be able to get them out the door in time for August.
Maybe worth noting too, Marshall, that it is a partial quarter statement. So it's almost a bit of an interim statement as under North Road, and the first full quarter will be the next quarter. That's a bit different. Under our old firms, when someone joined us and only had a partial quarter, we didn't often report full statements.
Right.
And we're doing our best to bring these up to speed as close as we can to what a full statement's going to look like.
That's great. Okay. The other thing I'd like to give an update on is just the investment process. So the core of our philosophy is going to remain the same. We believe that capital markets are very competitive. We are going to recommend and almost demand that clients stay massively diversified, and we want systems in place to force us to rebalance on targets and not on emotions. And we want to continue to drive decisions based on financial plans and targets that are made that tie into life goals and not just random things. We want to be driven by factors, and factors are how we describe the available investment returns that have been shown in marketplaces, that can be defined and measured, and we want to continue to build our portfolios on these factors. We are really interested in increasing the level of diversification that we have for our clients. So we're going to be increasing exposures to factors. We want to spend time with all of our clients to describe what factors exposures they've had in the last 5 or 10 years with us, or even 15 years with us, and then talk about options for factors going forward on our North Road. These aren't problems to fix. We're not trying to go out and fix portfolios. We're just going to give more options. And we weren't doing anything wrong in the past, so we don't have to fix a problem. We're just trying to say, how can we do things better? How can we diversify broader? And if we can have a higher expected return and or take less risk to search for that same return, we're going to do that. Cary, do you want to talk a little bit about some of the kind of new areas of diversification that we're looking at?
Yeah, you bet. I think one of the key things that is going to stay the same and is one of the underlying foundations of some new things we're going to bring forward is this idea that we want to be supported by academic research. And the academic research has continued to evolve over the last couple decades. And so there are traditional factors that folks may have heard of and that we've talked a lot about: value, size, profitability. There are some factors that have come about in the last couple of decades that are becoming easier to implement, such as momentum and some of these other areas and characteristics within markets that we're going to talk about, and you're going to hear us talk about over the many coming months and I'm sure years. So we've been doing a lot of research around additional factors that we can bring into portfolios to provide better diversification. We also are potentially seeing a change in interest rate and economic regimes. We've seen the first really big interest rate changes in the last year, and we're going to talk a little bit more about that as we go through some slides, Marshall. But if we are no longer in a falling interest rate environment or a falling or stable inflation environment, we may need to look at some deeper diversification. And we've been investigating that quite extensively in the last couple of months, along with our colleague Jaw, who joined us, who we used to work with at Pavilion back in the Pavilion days, and who helped to run portfolios back then with our team out of Winnipeg. So really happy to have Jaw on board. He's an awesome addition and just a brilliant guy. And so you and myself and Jaw, the three of us, have been working pretty hard around this area and reaching out to lots of our colleagues and thoughtful folks in the investment world that we know to help us start to build out some more options.
In a similar process as the Area 1 Canadian farmland process that we took on a few years ago, which the third cash call is happening next week. So we're getting ready to allocate our portfolios for that third call. That's the process of X diversification. We find an area of the capital markets or the area of the economy that we think should warrant a reasonable rate of return for the risk taken, and then we diversify. So that is where we're going to be embarking on for the rest of the year and next year as well.
I'm really excited about it, Marshall. I mean, you and I are both, we're kind of investment nerds. So for us to be able to dig into this and make some decisions and bring it to clients in a way that we are, pretty darn certain is going to be additive to portfolios and make lives better, that really excites me. I'm looking forward to it.
Let's jump into the update on capital markets, and we have a few slides that we're going to share and to kind of get across the points, hopefully a little clearer. So yeah, 2023 so far.
Okay,
Today's
we're going to touch
topics.
on, yeah, sort of five major areas today, Marshall. We'll talk a little bit about performance for the first half of 2023. We're going to touch on factors, which you've already brought up, and the traditional factors in particular that all clients hold in some form: value, size, profitability. We'll touch on interest rates and inflation, because those have just been huge topics in the last couple of years. And then we'll finish off by talking about staying invested, and because we're as diversified as we are, that's the right outcome and decision. Marshall, maybe I'll drive for a little bit, and then you hop in as you think of something I've missed. So I wanted to start by talking about the first half of the year and a couple of questions I've received from clients around how good returns sound, in particular out of the US. So this chart shows US stocks in 2023 for the first 6 months of the year, in particular the S&P 500 in blue and the NASDAQ, the tech-heavy NASDAQ, in orange. And you can see just incredible returns for the first half of the year: 31%, almost 32% in the NASDAQ, and almost 16% in the S&P 500. But as our short-term memories hopefully don't forget, last year was pretty gnarly. US stocks in 2022 for the NASDAQ minus 33, and for the S&P 500 minus 19. So if we look at the last 2 years of, if we were tech investors as an example, very highly concentrated in that area, we went down 33% to rise, 30% the following year. Not the experience I want to have, and nor what I want our clients to have. Marshall, do you want to touch on kind of the math behind this and why more stable portfolios are a good solution for folks?
Well, it's important to remember that a minus 30% does not equal a plus 30% in terms of wealth. Negative returns are mathematically more significant, and you need a higher positive return to keep your money at the same level should you have a negative return. So when we're building portfolios, we're very aware that if we can lower the severity of the negatives, we are going to do a better job long term of building wealth.
Yeah, and we can do some really simple math if folks want to sort of imagine this and see this in action. If you take a piece of paper and you write $100 on it, and you minus 30%, you get to 70. If you add 30% to 70, you don't get back to 100. Right? It's pretty awful. So, yeah, and it compounds, Marshall, if our clients are retired and they're drawing money. If we did some simple math again and said minus 30 brings you to 70, but you were taking out, let's say, 10% again from that, all of a sudden you're at 63 trying to get back to 100. That 30 is not going to get you anywhere close, right? That extra 30% on the other side. So just an indicator of why we think, even though it can be boring, stable, boring portfolios are the right way to go. I also thought, Marshall, it would be worth highlighting because we've heard a lot about AI recently. ChatGPT coming out in, I guess it was January, really lit a fire under some tech companies. So this chart shows us what the S&P 500 returns would look like if you removed, in this case, what the creators of this chart would call AI boom stocks, the stocks that really picked up once AI started hitting the headlines. And you can see it's pretty dramatic. The S&P 500 would be roughly flat without those AI companies really helping to lift returns. So is this a new bubble growing? That's one of the sort of headlines that's coming about right now. Impossible to know. One of our core theses is that we do not want to predict the future, but we definitely want to have stable portfolios that are going to reward us in the long term for staying invested. Anything you want to add there, Marshall?
That's good.
I thought this was an interesting chart to take a look at, Marshall. This looks at the outperformance of companies before and after they became one of the largest companies in the United States. So comparing companies as they rise into the top 10 largest companies and what happens afterwards and how they perform versus the overall market. So you can see on the left, huge run-ups in the years before joining the top 10, which makes sense. How would they join the top 10 if they weren't growing significantly? But then after they reach that size, it's pretty tough to keep going. And we see that after joining the top 10, that returns do not keep up with that initial rise. So this comes back. We often hear about not trying to chase returns. That I thought this was a nice graphical example of that.
If all we needed to do was buy the biggest, strongest of companies, well, if we could drive better returns from doing that, we would be all over that, because that does sound, and there's probably a good evidence that that would be a safer way to invest, but it doesn't turn out that way. The returns are lower, and we can cite a number of big examples of big companies blowing up, and just can't have that for our portfolios, for our clients.
Marshall, let's touch on factors, because one of the questions I got as the transition was happening with North Road from clients was that portfolio values seemed to be lower than they expected as they came over. And we chatted with a number of folks around this, recognizing that the transition and the money that came over was accurate, but prices on investments were moving. And one of the things that was frustrating for me in particular was recognizing that these factors that we believe will be additive to portfolios through diversification and potential returns, higher returns, were negative to portfolios during the second quarter. And the chart on the screen shows how often this happens. So of the US factors that we call market, so stocks versus bonds, size, large versus small, value, as an example, price to book or price to earnings, and profitability, 3 of those 4 factors were negative, as in they did not provide us with higher returns in the second quarter of this year. So that was frustrating. And we can see on the screen how often this happens in quarters. And that event of having 3 of these factors not provide additional returns for us, historically, back to the 60s, has only happened about 20% of the time, kind of 1 in every 5 quarters.
And Cary, those returns would have been exactly the same had we not made a business change versus making the business change. The exposures were the same.
That's right. Yeah, that's right. Yeah, good point. Okay. Marshall, anything on factors you want to touch on?
Yeah, like the investing in factors is good in the sense that it forces diversification, and it stops us from making kind of big mistakes in making kind of concentrated bets. But it isn't a guarantee to have great results at every interval. There's going to be some intervals where we're going to be disappointed. But by focusing on how portfolios have done over long periods of time, we are just bombarded with evidence that investing this way has worked well for past investors. And we don't want to let the results of a quarter or even a year push us off from these objectives and for the way that we've been building portfolios in order to make better results over much longer periods of time.
Yeah, we're going to talk a bit about inflation, and this is one of the areas that really made me thankful to be factor-focused firm for investments, because in 2022, when inflation was hurting lots of portfolios, and the concerns around inflation and rising rates were hurting lots of portfolios, the value factor did pick up and help us from a relative perspective. So let's dig into interest rates a little bit. Marshall, I grabbed this chart. I thought it was a really interesting way to see just how dramatic the change in interest rates has been over the last year and a bit. So this is U.S. Treasury total returns going back to the 70s, even through high inflation. We see that for the most part positive. And when we look at below the zero line, nothing is dramatically negative for total return in this area beyond 2022. It was a really tough year, not because absolute rates are higher than they have been historically, but the change in interest rates was so dramatic, so fast, that it really drove down returns in what arguably would be considered, I think, Marshall, globally, potentially the risk-free rate, quote unquote, for global portfolios. I think there are some folks in academia that may consider this as close as you get as sort of, as I say, quote unquote, risk-free. And here we have a very significant downturn. Yeah. Sorry, I just missed that. Say that again, Marshall.
I agree. Yeah, that's correct.
Yeah. One of the things that I have heard from clients, Marshall, a couple of times, just anecdotally, I've had folks say, how are people affording their lifestyle right now? Interest rates seem really high. Mortgage rates are high. Car loans are high. Food is growing in expense because of inflation. How are people spending and how are they affording things? And I thought this chart, there's lots here, but I just wanted to highlight something that under the kind of surface of economic conversations, I don't think we're hearing maybe quite as much as we should, which is that rising interest rates can take a long time to take effect. As we wait for mortgages to roll over, and in this chart, corporate debt to roll over, if interest rates stay high for a while, they may start to really bite into the economy and see a little less growth and
That's right.
and hopefully for our spending, less inflation, right?
Yeah, that is a good reminder. Increasing interest rates at the Bank of Canada level does not mean mortgage rates go up for existing debtors. Like, it takes a while for that mortgage to come due and to be renegotiated. So that could have bigger impacts definitely in years to come. And this is what we're going to have to watch.
Yeah. So this chart shows the sort of period of 2025 to 2028, more corporate debt in the United States being rolled over. One of the things that I always try and remind myself, Marshall, when I look at charts like this is, can we use this to invest and get higher returns? How would you answer that question?
Well, we don't know how the central banks will change interest rates a year from now. If we did, then we could make a lot of money off of that information. So yeah, all we can see is the current landscape of interest rates and debt, and make our positions on duration and credit quality accordingly. But we can't get ahead of the market.
Yeah. The only thing I would add as well that you and I always tell clients is price is the great equalizer. If we see this chart, there's a whole bunch of other smart investors out there seeing this chart and lots of other information, and they are selling or buying assets at prices they feel are reasonable, recognizing this information, right? We cannot predict the future. And can we ensure that we're ahead of all those other investors? It's very, 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 very difficult. So staying invested, looking to the long term is continuing to be our advice. Inflation is easing, which is nice to see. No guarantees, as we just said. We can't predict the future, but we can see even, recent inflation rate, while it's coming down, so the volatility of the change is getting better for us. We're still a long ways from that 2% target. So Bank of Canada is continuing to keep rates high, trying to rein in growth a little bit to get inflation down. And there's sometimes I feel, Marshall, a question mark as to why do we put pain into the economy in order to bring inflation down. And if we look back at the 70s and at economic theory, we're really trying, or the central banks are trying, to ensure that inflation doesn't become stuck in the economy, that people start to purchase things looking ahead because they don't want price increases, and they start buying now and heating the economy up and making inflation sticky. So that's, I think, a very simple form of the theory.
That's right. We want stability. People make better decisions when the business environment is stable, and high inflation is the opposite of stable, right? People don't know what to do. And yeah, it's bad for our economy. So this is good news, seeing that changes in interest rates are bringing it down. Maybe prices would have come down on their own. That's something we'll never know. But this is good news to see that.
So let's touch on inflation. I mean, it hurts our pocketbooks and hurts spending when we go to the store, and hurts our, I would say, even our emotional state a bit as we see things get expensive. You and I in the past have talked about me looking at shopping for new cars and just being shocked at how expensive things have gotten. Pardon me, when you start to include interest rates and inflation. As far as investing, does high inflation always mean a problem for stocks?
Look through time, and the obvious answer, it doesn't. No. Um, we have been rewarded with reasonable returns through time, in high and low period inflation, and we also can't be told when to get out of businesses and get out of equity markets with inflation information. It is just a part of the story, but it does not predict.
And then I thought, Marshall, we just touch on this idea of what have things looked like for increasing stock markets or versus decreasing stock markets over time. This chart goes back to 1926, so takes in part the Great Depression. Way on the left, you can see those negative returns, but also includes the 70s, includes 2008, 2009, early 2000s, and the dot-com boom and bust. So just a reminder that bull markets have continued to reward us for being patient. All right. How'd we do, Marshall? I think we're pretty close to the 30 minutes you and I set out here.
Good for time. Yeah, good for time. Yeah. It's good to be back on a webinar, and we're having to get back into our a more normal routine of doing some of these talks. So I can't wait to do more of these now.
Yeah, me too. Looking forward to how many emails we get letting people know we're rusty and need to get back into the swing, or if we did okay.
Yeah. Cary, thanks so much for putting some of these slides together, and it's been a fantastic few months working with you. And I wanted to say a big thanks to the team here at North Road. Honestly, like weekends, evenings, Saturdays, Sundays, I know our clients have gotten phone calls from us on Sunday mornings, and so glad that we were able to kind of walk this journey successfully. We had a fantastic response from our past clients asking us to kind of stay in their life. And, without clients, literally, we don't have jobs. So we were all able to keep our jobs, and we've been able to hire 3 more people onto our team. And we're going to be growing the team even more in the next few months. So a really, really big thank you for saying yes to keeping North Road in your financial lives.
Agreed. Enjoy the rest of your summer, everyone, and we'll talk to you very soon. Don't hesitate to reach out if you need anything.